Welcome back to the Deep Dive, your go-to source for cutting through the noise and delivering core insights from vast amounts of information. In today's world, we're all swimming in data, whether you're prepping for a big meeting, catching up on a new field, or just, feeding that insatiable curiosity. Our mission, as always, is to distill complex material into clear, actionable insights, specifically for you, the learner, who wants to be truly well-informed without getting overwhelmed. Today, we're embarking on a deep dive into a foundational, yet incredibly intricate area of direct tax laws, profits or gains from business or profession. This is a critical subject for anyone looking to truly grasp how business income is calculated for tax purposes. Whether you're a student bracing for rigorous application-based exams or a professional seeking a robust, nuanced understanding of these provisions, you're absolutely in the right place.
That's right. Our goal with this deep dive is much more than just helping you memorize rules. We want to empower you to understand the application and the nuances of these provisions. We'll equip you to tackle those challenging application-based exam questions and gain practical clarity on seemingly minor but incredibly significant details that can make all the difference in real-world scenarios. It's really about understanding the why behind the what.
And to guide us through this intricate landscape, our source material is a comprehensive text. It covers sections 28 to 44 DB of the Income Tax Act, 1961, alongside crucial rules, clarifications, and, importantly, a wealth of illustrative examples. We'll journey through the very definitions of business and profession, explore what constitutes admissible and inadmissible deductions, uncover the fascinating concept of deemed profits, delve into special provisions for various industries, and even touch upon how certain agricultural incomes are treated. Okay, let's unpack this.
Understanding business and profession.
So let's begin at the very beginning, the bedrock of our entire discussion. What exactly do we mean by business and profession when we talk about them for tax purposes? It might sound simple, but as you'll quickly discover, the legal definitions hold some surprising nuances that are absolutely vital to grasp.
You're right to highlight that. The Income Tax Act, 1961 through Section 213, gives a very broad definition to business. It includes any trade, commerce, or manufacture, or any adventure or concern in the nature of trade, commerce, or manufacture.
Yeah.
What's really key here is how sweeping this definition is. It doesn't just capture ongoing continuous activities that you might immediately think of as a business. It explicitly includes even a single venture if it's in the nature of trade. The underlying element that ties all of this together is always the presence of a profit motive, even if that specific activity isn't continuous.
Right. And then we have profession. Interestingly, the Act doesn't hand us a direct, concrete definition for profession. Instead, it's generally understood to imply an occupation requiring some degree of learning. Our source gives us a fantastic range of examples that really bring this to life. A painter, a sculptor, an author, an auditor, a lawyer, a doctor, an architect, and perhaps surprisingly to some, even an astrologer, are all considered to be carrying on a profession for tax purposes. It's also important to note that the term vocation is tucked in under Section 236, encompassing occupations where personal skill and intellectual effort are paramount, even if they're not strictly a profession in the traditional sense, like an artist pursuing their calling.
What's truly fascinating here is that for general assessment purposes, the distinction between a business, profession, or vocation is often not material. This means that, broadly speaking, profits from all these sources are typically treated and taxed alike under the same head of income. However, and this is where the subtlety of definition truly matters, there are critical exceptions. For instance, the threshold limits for tax audits and the specific provisions for presumptive income, where you declare a fixed percentage of your turnover as profit, apply different rates and limits depending on whether the activity is classified as a business or a profession.
Ah, okay.
This raises an important question for you, the listener. If the tax implications are mostly the same, why does the Act bother to make these distinctions in certain specific areas? The answer lies in the targeted application of specific rules and incentives, often designed to simplify compliance for certain groups or provide particular benefits.
So that defines what a business or profession is. But here's where it gets really interesting. Beyond just defining the activity, we need to understand what profits actually mean in this context. It's not always just about the cash changing hands.
Precisely. First, profits can be realized in money or in money's worth, meaning in cash or in kind. If you receive a profit in any form other than cash, like a valuable asset, the cash equivalent of that receipt on the date it was received must be taken as the value of the income. This ensures that non-cash benefits or perquisites are still brought to tax.
And a fundamental principle here, capital receipts are generally not taken into account when computing profits under this head. This is a critical distinction to remember, isn't it?
Absolutely. Capital receipts are typically for the enhancement or disposition of an asset, like selling a factory building, while revenue receipts are generated in the normal day-to-day course of business operations, like selling your manufactured goods. We also need to consider voluntary receipts. These can, surprisingly, become income, even if paid by parties who are under no legal obligation to pay anything. The key determinant is whether these payments were received in the course of carrying on your business or exercising your profession or vocation. For instance, if a lawyer receives a payment from someone who isn't their direct client, but who has clearly benefited from the lawyer's professional service to another party, that amount is assessable as the lawyer's income from their profession.
That's interesting. So it's about the connection to the professional activity.
Exactly. This can be a common point of confusion for learners, as it seems counterintuitive that a gift or non-obligatory payment could be taxable income.
And the interesting part is, the application of these gains is largely immaterial. This means that even if a public body makes gains, and those gains are ultimately used for community benefit, they are still liable to tax. The core requirement here is that the business, profession, or vocation must be carried on for at least some time during the accounting year, not necessarily throughout. And it doesn't even need to be carried on by you, the owner, personally. It just needs to be under your direction and control.
Furthermore, when you have income from distinct businesses, say you run a manufacturing unit and a trading firm, the profits of each individual business must be computed separately. However, the tax chargeable under this section is not on the separate income of every distinct business, but rather on the aggregate profits of all the businesses you carry on. This means your profits and losses from different businesses under this head are essentially netted off.
In terms of computation, a foundational principle is that profits should always be computed after deducting the losses and expenses genuinely incurred for earning the income in the regular course of the business, profession, or vocation. This is fundamental, unless, of course, the loss or expense is expressly, or by necessary implication, disallowed by the Act. The charge, therefore, is not on your gross receipts, but specifically on the profits and gains you've made after factoring in all your legitimate costs.
This brings us to a really thought-provoking point about the legality of income. The illegality of a business, profession, or vocation does not exempt its profits from tax. The revenue authorities are not concerned with the taint of illegality in the income or its source. So income tax is not restricted in its application to only lawful businesses. Even profits from illicit activities are taxable.
Wow, okay, but there's a catch, right?
Yes, and this is a crucial caveat for application-based questions. Any expenditure incurred by you for a purpose which is an offense or which is prohibited by law would not be allowable as a deduction while computing the profits of such a business. The distinction is key. The income is taxed, but expenses directly tied to the illegal act are not deductible. The law taxes all income, but it doesn't subsidize illegal activity.
That makes sense. A critical distinction. 2. Income chargeable under this head, Section 28.
So we've laid the groundwork for what business and profit mean in a general sense. Now let's move from the broad definitions to the specific items of income that Section 28 specifically identifies as chargeable under profits and gains of business or profession. This is the heart of what actually gets taxed, isn't it? Precisely. The most obvious item, of course, is the direct income arising to any person by way of profits and gains from the business or profession they carried on at any time during the previous year. But Section 28 reaches beyond just these direct operational profits. It also includes specific types of compensation that are inherently linked to business relationships. For instance, any sum, by whatever name called, received by a person holding an agency in India at or in connection with the termination or modification of the agency terms is taxable under this head. Similarly, if your property or business management is vested in the government or a government-controlled corporation, any receipts you get in connection with that vesting are also taxed here. These provisions are designed to capture compensation that directly arises from business relationships or their cessation.
Beyond compensation, Section 28 also includes certain export incentives. So, cash assistance received or receivable from the government of India against exports under any scheme, or any customs duty or excise duty repaid or repayable as a drawback, are specifically brought under this head. And quite practically, any profit you make on the transfer of a duty entitlement passbook scheme or a duty-free replenishment certificate is also deemed business income. These are direct benefits tied to export-oriented business activities and thus treated as part of your business gains.
Next, we have the value of any benefit or perquisite. This is a broad inclusion, emphasizing that the value of any benefit or perquisite arising from your business or the exercise of your profession is taxable, whether it's convertible into money or not, and whether it's received in cash or in kind, or partly so. A clear example from the source illustrates this. If a company provides rent-free residential accommodation to a lawyer in consideration of professional services rendered, the value of that accommodation is accessible in the lawyer's hands as business income. This is a key application point, highlighting that non-monetary benefits can indeed have a tax implication.
And a very common scenario involves sums due to or received by a partner of a firm. Any interest, salary, bonus, commission, or remuneration, by whatever name called, due to or received by a partner from their firm is deemed to be income from business. Now, here's the crucial part, especially for application questions. If any portion of this amount was disallowed to the firm under Section 40B, for example, if the interest rate paid to the partner exceeded the allowable 12% per annum, that disallowed portion is not taxed again in the partner's hands.
That's a critical anti-double taxation measure. Let's say a firm pays a partner 20% interest, but only 12% is allowable as a deduction to the firm. The excess 8% has already effectively suffered tax by being disallowed as a deduction for the firm.
Ah, I see.
So it isn't taxed again in the partner's hands. However, the interest allowed to the firm, up to 12%, will be taxed in the partner's hands. We should also briefly mention Section 10(2)(a), which provides an exemption for the share income of a partner from the firm, again, to avoid double taxation on the firm's overall profits.
Finally, Section 28 carefully excludes certain specific transfers from this head. Any sum, whether received or receivable, in cash or kind, on account of the transfer of the right to manufacture, produce, or process any article or thing, or the right to carry on any business or profession, which is already chargeable under the head capital gains, is not included here. Makes sense. Prevents double taxation under different heads.
Exactly. Also excluded is any compensation received from the Multilateral Fund of the Montreal Protocol on substances that deplete the ozone layer, a specific international agreement. 3. Speculation business, Section 28, Explanation 2, and Section 43.5.
Let's pivot our focus now to a very specific type of business that gets unique treatment for tax purposes: speculation business. What makes this particular activity distinct, and why does the tax law treat it separately from other business income?
It's a critical carve-out. Explanation 2 to Section 28 explicitly provides that where you carry on speculative business, that business must be treated as distinct and separate from any other business. The why it matters comes sharply into focus with Section 73. Unlike losses from other types of business, losses from speculation business cannot be set off against the profits of any other business. They can only be set off against other speculation business profits. Similarly, if a loss in speculation business is carried forward, it can only be set off against the profits and gains of any speculative business in a future year.
Okay, so that separation is key for loss treatment.
Exactly. This separation is vital for tax planning and ensures that speculative losses don't artificially reduce your regular business income.
So what does this all mean for you? And how is a speculative transaction even defined?
Section 43.5 provides clarity. A speculative transaction means a transaction in which a contract for the purchase or sale of any commodity, including stocks and shares, is periodically or ultimately settled, otherwise than by actual delivery or transfer. Think of it as pure paper trading, where you don't actually take possession of the underlying asset.
Right, settled without delivery.
And it was a specific deeming provision for companies. Where any part of a company's business involves the purchase and sale of shares of other companies, that company is deemed to be carrying on speculation business to that extent. This means a company trading in shares for short-term gains without actual delivery might find that specific portion of its business classified as speculative for tax purposes.
But immediately, there are crucial exceptions to this deeming provision for companies. Not all share trading by companies is speculative, right?
Correct. This deeming provision does not apply to a company whose gross total income consists mainly of income from sources like interest on securities, income from house property, capital gains, and income from other sources. More importantly, it also doesn't apply to a company whose principal business is specifically trading in shares, banking, or granting loans and advances. So if these types of companies trade shares, they are not deemed to be carrying on a speculation business.
Okay, that's a vital nuance for understanding the scope.
It really is. This distinguishes genuine financial activities from pure speculative ones. Beyond these company-specific exceptions, there are several forms of transactions that are specifically not deemed to be speculative, even if they involve settling contracts without actual delivery. This often relates to genuine risk management. First, we have hedging contracts for raw materials or merchandise, entered into to guard against loss through future price fluctuations for actual delivery contracts in manufacturing or merchandising.
So protecting against real business risks.
Exactly. Second are hedging contracts in stocks and shares for dealers or investors guarding against price fluctuations in their holdings. Third, forward contracts by a member of a forward market or stock exchange in the course of jobbing or arbitrage. These cover essential market-making activities. Fourth, trading in derivatives is also carved out, specifically if it's an eligible transaction carried out on a recognized stock exchange. And fifth, trading in commodity derivatives is also excluded, again, if it's an eligible transaction carried out on a recognized stock exchange and is chargeable to Commodities Transaction Tax, CTT.
CTT.
Yes, Commodities Transaction Tax. A key point here is that the requirement of CTT chargeability is not applicable for trading in agricultural commodity derivatives, providing a specific exemption for that sector.
It's clear the law wants to differentiate genuine risk management and market facilitation from pure speculation, but what exactly constitutes an eligible transaction for these derivative and commodity derivative carve-outs? It sounds quite specific.
It is quite detailed, focusing on transparency and regulation. The transaction must be carried out electronically on screen-based systems through a registered intermediary in accordance with various regulatory acts. Furthermore, it must be supported by a time-stamped contract note issued by the intermediary, clearly indicating the unique client identity number and the client's permanent account number, PAN-N. For commodity derivatives, it also requires a unique trade number.
Okay, so very strict compliance.
Yes, this level of detail emphasizes the strict compliance required to ensure these transactions are genuinely eligible for non-speculative treatment, ensuring they are not just paper gambles. 4. Method of accounting, Section 145, and Income Computation and Disclosure Standards, ICDS.
Now that we've covered what constitutes business income and even the nuances of speculative business, let's move to how this income is actually computed. Section 145 is the starting point, isn't it?
Yes. It states that income chargeable under profits and gains of business or profession, or income from other sources, must be computed using either the cash or mercantile system of accounting, consistently employed by you, the assessee.
So you stick to one system.
Generally, yes. Consistency is key. This is where the crucial Income Computation and Disclosure Standards, ICDS, step in, notified under Section 145(2). These standards provide a framework for income computation specifically for tax purposes. There are 10 notified ICDSs covering a wide range of areas, from accounting policies to valuation of inventories, construction contracts, revenue recognition, and borrowing costs.
And these ICDS have some cardinal features that are incredibly important to understand, especially when you're looking at application. What are those?
Well, first, their applicability. They are only for the computation of income chargeable under profits and gains of business or profession or income from other sources. They are not for the purpose of maintaining your general books of account.
Computation versus bookkeeping. That's a key difference.
It is. This is a common point of confusion. Second, in case of any conflict between the provisions of the Income Tax Act, 1961, and the notified ICDSs, the provisions of the Act shall always prevail. This is a fundamental rule, a clear hierarchy.
The act is supreme.
Got it. Building on that, each ICDS also has a clear scope paragraph explaining what it deals with and sometimes specifically what it does not deal with. This helps avoid misapplication. And finally, almost all ICDSs contain transitional provisions designed to ease first-time adoption and prevent any potential tax leakage or unintended double taxation when shifting to these new standards.
Okay, so they thought about the transition. Can you give us a flavor of some key ICDSs?
Sure. Let's highlight some key ones and their core principles, which is vital for exam preparation. ICDS-I. Accounting policies emphasizes that the treatment of transactions must be governed by their substance, not merely their legal form. It also states that a mark-to-market loss or an expected loss is not to be recognized unless another ICDS specifically allows it. This prevents arbitrary loss booking for tax purposes.
Substance over form and limits on recognizing expected losses. Makes sense.
Then ICDS-II. Valuation of inventories requires inventory to be valued at cost or net realizable value, whichever is lower. This comparison is done category-wise, not for each individual item, which can significantly impact your closing inventory value.
Category-wise. Okay, not item by item.
Right. ICDS-III. Construction contracts applies to contractor income and generally recognizes revenue and costs using the percentage of completion method, ICDS-III. Revenue recognition focuses on when revenue from sales, services, interest, royalties, or dividends can be recognized, often tying it to a reasonable certainty of ultimate collection.
Reasonable certainty of collection. That sounds practical.
It aims to be. ICDS 7.
Right.
Government grants is interesting. It states that grants should be recognized when there's reasonable assurance of compliance with conditions and receipt. But crucially, recognition should not be postponed beyond the date of actual receipt. Grants related to depreciable fixed assets are typically reduced from the asset's cost or written down value.
So recognize grants when you get them, basically.
Pretty much, if the conditions are met. ICDS 8. Securities dictates that securities held as stock in trade are valued at cost or net realizable value, whichever is lower, on a category-wise basis. And ICDS X, provisions, contingent liabilities, and contingent assets, specifies strict conditions for recognizing a provision. A present obligation, reasonable certainty of resource outflow, and a reliable estimate. Crucially, you cannot recognize a contingent liability or a contingent asset until it becomes reasonably certain that an inflow of economic benefit will arise.
Strict rules for provisions, and no recognition of contingent items until they're almost certain. Okay. Now, let's look at some important clarifications on ICDS provided by a specific circular. These address common questions, right?
Indeed. These address common questions that have come up and are directly relevant for practical application and exam scenarios. One clarification, question 1, addresses the interplay between ICDS and the maintenance of books of accounts. It reconfirms that ICDS is for income computation, not book maintenance, but acknowledges that accounting policies applied for book purposes are also applied for tax computation, subject to ICDS.
So, some overlap in practice.
Yes. Question 4 confirms that if there's a conflict between ICDS and other specific income tax rules, the rules will always prevail.
Rules trump ICDS.
Right. Question 5 clarifies that ICDS applies for the computation of taxable income under profits and gains of business or profession, irrespective of whether companies follow accounting standards or IND AS for their financial reporting. This means your tax computation has its own set of rules separate from your financial reporting.
That's a really important point for companies using IND AS.
Definitely. And question 6 clarifies that ICDS does not apply for computation of minimum alternate tax, MAT, or alternate minimum tax, AMT, as these are based on book profit prepared under the Companies Act, which is distinct from regular income computation.
So MAT have their own basis.
Correct. A practical clarification from question 19 relates to ICDS 8th for valuing securities held as stock in trade. The rule is to first aggregate securities category-wise, for e.g. shares, debt securities. Then for each category, you compare the aggregate cost with the aggregate net realizable value, NRV. The lower of the two aggregates for that category is taken as the carrying value. This is a prime example of how a seemingly minor detail of valuation can significantly impact your final tax computation.
That category-wise comparison makes a difference.
It certainly can. Finally, question 20 clarifies that borrowing costs to be capitalized under ICDS IX should exclude any portion of borrowing costs that would get disallowed under specific provisions of the Act, such as Section 14A or 43B. Only the portion of borrowing costs that is otherwise allowable as a deduction under the Act can be capitalized. This reinforces that specific disallowance rules of the Act override general capitalization principles in ICDS.
Okay, so the Act's specific disallowances take precedence even over ICDS capitalization rules.
Precisely. V. Computation of profits and gains, Section 29.
So after laying down the broad definitions, the specific types of income chargeable, and the accounting standards that guide computation, Section 29 briefly brings it all together. It essentially states that the profits and gains of any business or profession are to be computed strictly in accordance with the provisions contained in Sections 30 to 43D of the Income Tax Act.
That's right. And it's important to remember that while Sections 30 to 36 lay out specific allowances and deductions, Section 37(1) acts as a residuary section.
The catch-all provision.
Exactly. This is the catch-all provision. It permits the allowance of business expenditure not specifically covered by Sections 30 to 36, provided these expenses are allowable according to accepted commercial practices. This ensures that genuine business expenses, even if not explicitly listed elsewhere, can still be deducted. 6. Admissible deductions, Sections 30 to 37.
Okay, let's unpack this with what most businesses want to know. What expenditures can be deducted from your business income? This is where many of the practical details and calculations lie, starting with buildings, machinery, plant, and furniture. A. Buildings, machinery, plant, furniture, sections of 3031.
Section 30 allows deductions for rent, rates, taxes, repairs, and insurance of buildings used for business or profession. If you're a tenant, you can deduct the rent paid and the cost of repairs you've undertaken. If you're the owner, there's no notional rent deduction, obviously. But if a firm uses a partner's premises, the rent paid to the partner is deductible if it's reasonable. Expenses incurred on repairs, whether by owner or tenant, are deductible.
And if the building's used partly for business?
Then only a proportionate part of those expenses is allowed as a deduction. That's under Section 30.
Fair enough.
Moving to Section 31, it covers repairs and insurance for machinery, plant, and furniture. The key condition here is that current repairs do not include capital nature expenditure.
Ah, the capital versus revenue distinction again. Very important.
Absolutely critical. Only revenue repairs are allowed here, not improvements that add enduring benefit or value to the asset itself. B. Depreciation, Section 32.
This is a big one, perhaps the cornerstone of business taxation. Depreciation. It allows businesses to deduct the cost of their assets over their useful life, rather than all at once. The concept revolves around a block of assets, right?
That's correct. A block of assets refers to a group of assets falling in the same class, like all furniture or all plant and machinery, attracting a 15% rate, and for which the same rate of depreciation is prescribed.
So to understand depreciation, we need to clarify what counts as plant for tax purposes. It's quite broad, isn't it?
It is. Section 43.3 broadly includes ships, vehicles, books, scientific apparatus, and surgical equipment used for business. Essentially, it covers most goods and chattels, fixed or movable, that a business keeps for use with some durability. However, it specifically excludes buildings, furniture, and fittings, and importantly, stock in trade.
Okay. And what are the conditions for claiming depreciation?
There are two main ones. Firstly, the asset must be owned by the assessee. This isn't just strict legal ownership. Beneficial ownership counts too, which is crucial for things like leasing. Actually, the Supreme Court clarified this. They said anyone in possession with dominion and the right to use and enjoy property is considered the owner for depreciation, even if legal registration is pending.
Interesting. So possession and right to use can be enough.
Yes, in certain circumstances. Secondly, the asset must be used for business or profession at any time during the previous year. It doesn't have to be used throughout the year, nor is the depreciation allowance proportionate to the period of use. However, and this is key, if an asset is acquired but not put to use at all in the same year, no depreciation is allowed for that year. Its cost just gets added to the block for future years.
So acquisition isn't enough. Put to use is essential for the first year's claim. Now, we have the normal depreciation, but what about other types of depreciation that offer specific incentives or cover unique scenarios?
Right. Beyond normal depreciation under Section 32, calculated at specified rates on the written down value WDV of the block, we have additional depreciation under Section 32. This is a significant incentive, providing an extra 20% of the actual cost for new machinery or plant, not secondhand acquired and installed by businesses engaged in manufacture or production, or in generation, transmission, distribution of power.
So an extra boost for manufacturing and power sectors. Are there exclusions?
Yes. It excludes things like ships, aircraft, office appliances, and road transport vehicles. And there are crucial conditions for additional depreciation. As I said, it's not allowed for secondhand machinery. And a very important rule. If the asset is put to use for less than 180 days in the acquisition year, the additional depreciation is restricted to 50% of the normal rate, so 10% instead of 20%, with the balance 50% allowed in the immediately succeeding year.
Okay, the 180-day rule affects the timing of the second half of the benefit.
Exactly. The tax regime impact is also significant here. For individuals, HUFs, and certain other assessees, additional depreciation is not allowable if they opt for the default tax regime under Section 115 BAC. Similarly, for companies and cooperative societies, it's not allowable if they opt for special concessional regimes like 115 BAA or BAB. It's only available if they choose to pay tax under the normal provisions.
So choosing a concessional regime means giving up this extra depreciation.
Generally, yes. A specific clarification also states that printing and publishing businesses are eligible for additional depreciation as they amount to manufacture or production.
That's useful clarification for that industry. What's fascinating here is how tax law clarifies treatment for highly specific industries. Let's delve into the farm-in expenditure for oil and gas exploration and production, E&P companies. This is about acquiring participating interest, PI, in production sharing agreements, PSC, right?
Yes. This was clarified by Circular Number 20/2019. The key insight is that the amount paid for a PI is not treated as buying a partnership share or an investment in an AOP BOI. Instead, it's treated as acquiring the underlying assets of the E&P contract. After accounting for any tangible assets acquired, the remainder of the cost is treated as an intangible asset, akin to a business or commercial right or license, and is therefore eligible for normal depreciation under Section 32.
So the payment for the participating interest itself becomes depreciable as an intangible. Very specific.
It is. It shows how tax law adapts to complex industry specificities and large investments.
This sounds complex, so let's walk through an illustrative example from our source material for depreciation computation rules. This is from illustration 1 on pages 3.41, 3.42, detailing the computation for XYZ PLTD, a manufacturing business. Can you walk us through that?
Certainly, this illustration clearly shows the interplay of these rules. First, you start with the opening WDV of the different blocks of assets, say plant and machinery at 15%, furniture at 10%, computers at 40%. Then you add the actual cost of new assets acquired during the year. For each addition, you check if it was used for more or less than 180 days. If more, it gets the full normal depreciation rate. If less, it gets only 50% of the normal rate for that year. Next, you consider additional depreciation. This applies only to new plant and machinery used in manufacturing or power. Again, the 180-day rule applies. If used less than 180 days, only 10% additional depreciation this year, the balance 10% next year. Full 20% if used more than 180 days.
And what about assets sold?
Right. Any money received from selling assets within a block reduces the WDV of that block before calculating depreciation for the year. The illustration clearly shows this calculation for different assets like new machinery, a secondhand machine, no additional depreciation, a computer, 40% block, subject to 180-day rule, and an office AC, no additional depreciation as is an office appliance. By meticulously following these steps, additions, deletions, sales proceeds, applying normal depreciation, full or half rate, applying additional depreciation, full or half rate or nil, you arrive at the total allowable depreciation for the year and the closing WDV for each block.
That example really clarifies the mechanics. So those are the general depreciation rules. What happens when businesses undergo reorganization, like a succession of a firm by a company, amalgamation, or demerger? Is depreciation just lost?
No, it's handled quite logically. Under the sixth proviso to Section 32(1)(32), the depreciation allowable for the year of transfer is apportioned between the predecessor, the entity transferring, and the successor, the entity receiving. This apportionment is done based on the number of days each entity used the asset during that previous year. So it ensures a fair division of the depreciation benefit in the year the business structure changes.
Okay, apportionment based on usage days. Now let's talk about the actual cost, as defined in Section 43(1). This seems fundamental for calculating depreciation.
It absolutely is. Generally, actual cost is the cost of the asset to you, the assessee, reduced by any portion of that cost met directly or indirectly by another person or authority, like a government subsidy. But there's a crucial anti-avoidance rule related to cash payments. If you acquire an asset and a payment or aggregate of payments to a single person in a single day exceeds $10,000, and this payment is made otherwise than by an account, paycheck, draft, or prescribed electronic modes like UPI, net banking, cards, etc., then that expenditure shall not form part of the actual cost of the asset for depreciation purposes.
Wow, 10,000 cash limit per person per day for asset acquisition costs too. That's strict.
It is. It's designed to promote transparency and discourage large cash transactions, even in capital expenditure.
Are there special situations covered under actual cost?
Yes. Section 43(1) also has several explanations for special situations. For instance, Explanation 5. If an asset is first used for scientific research, where 100% deduction might have been claimed under S35, and then brought into business use, its actual cost for business depreciation is taken as nil. Explanation 6. If an asset is acquired through gift, inheritance, amalgamation, or demerger, its actual cost for the recipient is generally deemed to be the actual cost to the previous owner, less any depreciation already claimed by the previous owner. A key point in Explanation 8 clarifies interest capitalization. Interest paid or payable on funds borrowed specifically for acquiring an asset relating to the period after that asset is first put to use is not included in its actual cost. It must be claimed as a revenue expense year on year if eligible. This counters tax avoidance by preventing ongoing financing costs from being capitalized and depreciated indefinitely.
So interest starts being capitalized once the asset is ready and used.
Correct. Explanation 10 states that the cost of an asset must be reduced by any government subsidy or grant received for its acquisition. If the subsidy isn't directly tied to a specific asset, a pro rata reduction applies across relevant assets. This links back to ICDS 5 we discussed earlier.
Okay, that covers actual cost. And what about the written down value, WDV itself, as defined in Section 43(6)? How is it calculated, especially when assets change hands or tax exemptions apply?
WDV is the base for calculating depreciation year after year. For assets acquired during the current previous year, the WDV is simply their actual cost, as determined under S.431. For assets acquired before the current previous year, the WDV is the actual cost less, the aggregate of all deductions actually allowed for depreciation in previous years. Any depreciation claimed and allowed, including unabsorbed depreciation carried forward, reduces the WDV.
So it keeps track of depreciation already claimed.
Exactly. In cases of succession or inheritance, like a son taking over his father's business, the WDV in the hands of the successor is simply the WDV that existed for the predecessor just before the transfer. A very important rule, Explanation 6 to Section 43.6, applies when a previously tax-exempt entity, like a charity that loses its exemption, becomes taxable. To calculate depreciation going forward on assets acquired during its exempt years, the depreciation that would have been allowable under the Act for those exempt years is deemed to have been actually allowed.
So they can't start depreciating from the original full cost again.
Precisely. It prevents them from getting a double benefit by effectively claiming depreciation for the exempt period again. This ensures the WDV reflects a notionally depreciated value from the start of taxable status. See T Development Account, Section 33AB.
Beyond general deductions like depreciation, the Act provides special incentives for specific industries. Let's look at the Tea Development Account under Section 33AB. What's that about?
This section provides a deduction for businesses growing and manufacturing tea, coffee, or rubber in India. It's an incentive to reinvest profits back into the development of these plantation industries. You can claim a deduction for the amount you deposit in a special account with NABARD, National Bank for Agriculture and Rural Development, or in a specific deposit account. The deduction is the lower of the amount deposited, or 40% of the profits of that business, computed before making this deduction and before adjusting any brought forward business losses.
So it's a significant potential deduction up to 40% of profits if you make the deposit.
Yes, it is. But it's not available to partners deriving share income from a firm engaged in this business. And once you claim the deduction in one year, you can't claim it again for the same amount in another year. Crucially, to claim this deduction, your accounts for that year must be audited by a chartered accountant and the report submitted by the return filing due date.
What happens if you take the money out or don't use it properly?
There are consequences. The amount withdrawn can only be used for specific purposes outlined in the approved scheme. If you withdraw it for closure of business or utilize it for purchasing assets prohibited by the scheme, like office appliances or machinery that would give 100% deduction elsewhere, or don't use it within the specified time frame, the amount withdrawn or misused is deemed to be business profits of that year and taxed accordingly. Also, if you buy an asset using these funds and sell it within 8 years, a portion of the asset's cost, equal to the deduction claimed, is deemed income in the year of sale, clawing back the benefit. There are exceptions for transfers to the government or in cases of business succession where a firm converts to a company.
So strict rules to ensure the funds are used for genuine development.
Yes, the goal is actual reinvestment in the tea, coffee, or rubber business. D-Site Restoration Fund, Section 33 ABA.
Similar to the Tea Development Account, but for the petroleum and natural gas sector, we have the Site Restoration Fund under Section 33 ABA. Is it structured similarly?
Yes, it's quite similar in principle, but tailored for the oil and gas industry. It allows a deduction for businesses involved in prospecting for, or extracting or producing petroleum or natural gas, or both, in India, provided they have an agreement with the central government. The deduction is the lower of the amount deposited in a special account with the State Bank of India or in a specific site restoration account, or 20% of the profits of that business, calculated before this deduction and before brought forward loss adjustments.
So 20% limit here compared to 40% for tea, coffee, rubber?
Correct. Like Section 33AB, it's allowed before brought forward losses, not available to partners members of firms, AOPs, VOIs, and requires an audit of accounts. The consequences for withdrawal for non-specified purposes, non-utilization, or premature sale of assets acquired using the fund are also very similar to Section 33AB. The amounts involved are generally deemed to be business profits and taxed in the year that non-compliance occurs. The exceptions for government transfers or firm-to-company succession also apply here.
Okay, another targeted incentive with specific compliance requirements. Expenditure on scientific research, Section 35. Now let's move to a really crucial area for innovation and economic growth. Section 35, dealing with deductions for expenditure on scientific research, this seems like a major incentive area.
It absolutely is. The Act provides significant deductions here to encourage R&D activities. First, we need to understand scientific research. It broadly means activities for extending knowledge in natural or applied sciences, including agriculture, animal husbandry, or fisheries. The deductions depend on whether the research is done in-house or through contributions to external entities. Let's start with I, expenditure incurred by the assessee, in-house R&D, revenue expenditure. Any revenue expense incurred on scientific research related to your business is allowed as a 100% deduction in the year it's incurred. This also includes pre-commencement revenue expenses, like salaries, materials, incurred within 3 years before starting the business, provided they are certified by the relevant authority. Capital expenditure. Any capital expenditure incurred on scientific research related to your business is also allowed as a 100% deduction in the year it's incurred. This is a huge benefit, immediate write-off. However, this deduction is not available for the cost of land. Pre-commencement capital expenditure, again excluding land, incurred within 3 years prior is allowed as a deduction in the year the business commences.
100% deduction for both revenue and capital, except land. That's very attractive. What happens if you sell an asset acquired for research?
Good question. There's a clawback provision under Section 41(3). If a capital asset used for scientific research, for which 100% deduction was claimed under S35 is later sold without having been used for other purposes, the sale proceeds are taxable as business income, but only up to the amount of the deduction originally allowed. So if you got a 5 lakh deduction and sell it for 6 lakh, 5 lakh is taxed. If you sell it for 3 lakh, 3 lakh is taxed.
It prevents realizing the value tax-free after getting a full write-off. Makes sense. What about tax regimes?
This is a significant point. Crucially, these deductions for in-house R&D, both revenue under 35 and capital under 35(1), are generally available even if you opt for the special concessional tax regimes, like Section 115BAC for individuals, AD devs, or 115BA BAB for companies. This makes them widely applicable incentives.
Okay, so in-house R&D deductions survive the concessional regimes. What about contributions paid to external research entities?
Here, the treatment under concessional regimes differs. You can deduct 100% of sums paid to an approved research association, university, college, or other institution for scientific research. This doesn't even have to be related to your own business. An approved Indian company whose main object is scientific R&D. An approved institution for research in social science or statistical research. An approved national laboratory, university, IIT, or specified person for an approved scientific research program.
So 100% deduction for contributing to these approved external bodies. How does this interact with the tax regimes?
This is where the difference lies. Unlike the in-house deductions, these deductions for contributions to external entities are generally not available if you opt for the default tax regime, Section 115BAC for individuals HUFs, or the special corporate cooperative society regimes, 115B ababa.
So if you take the concessional rate, you generally lose the deduction for funding external research. That's a critical distinction for planning.
It absolutely is. You need to weigh the benefit of the concessional rate against the loss of these specific deductions.
Now, there's a very specific high-value deduction for certain companies. 3, expenditure by companies on in-house R&D under Section 35(2)AB. What's special here?
This section offers a substantial incentive specifically for companies engaged in the business of biotechnology or in the manufacture or production of any article or thing, except for a few excluded items like alcohol, tobacco, cosmetics listed in the 11th schedule. They can claim a 100% deduction of expenditure incurred on their in-house research and development facility, provided it's approved by the prescribed authority. Again, this deduction excludes the cost of land and building.
So similar 100% like 35,
Yeah.
but specifically for these manufacturing biotech companies. And it excludes buildings too.
Yes, the exclusion of buildings is specific to 35(2)AB. For drugs and pharmaceuticals, this section explicitly includes expenditure on clinical drug trials, regulatory approvals, and patent filing as eligible R&D costs. A key condition is that if you claim this deduction under 35(2)AB, you cannot claim the same expenditure under any other provision of the Act, notably Section 35(1) or 35(1). It prevents double dipping. The company also needs to enter into an agreement with the prescribed authority and follow specific audit and reporting rules.
Let's try to illustrate this with an example. Say a company, Innovate Ltd., incurs various research costs. How would they be treated?
Okay, let's say Innovate Ltd is a manufacturing company eligible for 35(2)AB. They spend 50 lakhs on revenue expenses, salaries, materials, for their approved in-house R&D facility. This entire 50 lakhs is deductible under 35(2)(ab). They purchase machinery worth 2 crore for the R&D facility. The full 2 crore is deductible under 45 for the HAB. They construct a building for the R&D facility costing 3 crore. This 3 crore is not deductible under 35(2)(ab) because buildings are excluded. Normal depreciation under S.2 might be available on the building though. They purchase land for 1 crore. Land is also not deductible under 35(2)(ab). They also contribute 20 lakhs to IIT Delhi for an approved scientific research program. This 20 lakhs is deductible under section 35(2)(aa). But remember, this contribution might not be deductible if Innovate Ltd opts for a concessional tax regime like 115(b)(a).
That really clarifies the scope and exclusions, especially for 35(2)(ab) versus other parts of Section 35F, expenditure for obtaining right to use spectrum, Section 35(aba). Now, let's move into the digital age assets. What about something like spectrum, which is essential for telecom companies? How is the significant cost of acquiring the right to use spectrum treated for tax purposes? Is it depreciated?
There was some uncertainty initially, but Section 35(aba) provides specific treatment. It's amortized, not depreciated under Section 32. Any capital expenditure incurred for acquiring the right to use spectrum, for which payment has actually been made, is allowed as a deduction in equal installments over the period for which the right remains in force. The deduction amount each year is the appropriate fraction, which is calculated as 1 divided by the total number of relevant previous years, essentially the remaining life of the spectrum right.
So spread evenly over the spectrum's life, what does payment actually made mean here?
It means the actual outflow of funds, not just when the liability is incurred according to accounting. This is important for deferred payment plans. If payment is deferred, the deduction is allowed only in the years the installments are actually paid, based on the amount paid.
What happens if the company later transfers or sells the spectrum right?
Section 35(aba) has detailed rules for consequences of transfer. If the sale proceeds are less than the expenditure remaining unallowed, the difference, unallowed amount minus proceeds, is allowed as a deduction in the year of transfer. If the sale proceeds exceed the unallowed expenditure, the excess amount is chargeable as business profits in the year of transfer. However, this taxable profit is capped at the amount of deduction already allowed in earlier years. If only part of the spectrum is transferred, the proceeds reduce the unallowed expenditure and the balance is amortized over the remaining years. In case of amalgamation or demerger, the successor company continues claiming the deduction for the remaining period as if no transfer occurred.
Complex rules for transfer, essentially ensuring the net tax impact reflects the actual cost incurred versus proceeds received over the life, including the transfer.
Exactly. It tries to achieve a fair outcome, whether the right is held to expiry or transferred midway. G. Expenditure for obtaining license to operate telecommunication services, Section 35(abb).
Following a similar logic to spectrum, how is the expenditure for obtaining a direct license to operate telecommunication services treated? Is that also amortized?
Yes, Section 35(abb) provides a very similar amortization regime for the license fee itself. Any capital expenditure incurred for acquiring such a license, for which payment has actually been made, is deductible in equal installments over the period the license is in force. The calculation uses the same appropriate fraction concept, 1 divided by the number of relevant previous years. The definitions of relevant previous years and payment has actually been made are also similar to Section 35(aba).
And the consequences of transferring the license.
Also very similar. The rules for handling situations where sale proceeds are less than, equal to, or greater than the unallowed expenditure, including the cap on taxable profit based on deductions already claimed, mirror those in Section 35(aba). The treatment in amalgamation demerger is also the same. The successor continues the amortization. A critical point here, explicitly stated in Section 35(abb), is that if a deduction is claimed and allowed under this section for the license fee, no depreciation under Section 32 can be claimed on the same expenditure in any year.
Okay, prevents a double benefit, either amortization under 35(abb) or depreciation under 32, but not both. Let's look at the illustration for this.
Right, the illustration for Section 35(abb), pages 3.84, 3.85 shows this clearly. If EasyCall Ltd gets a 10-year license for 50 lakhs, the annual amortization is 5 lakhs, 50 lakhs, 10 years. If they sell it after 2 years, having claimed 10 lakhs deduction, leaving 40 lakhs unallowed. Scenario 1, sold for 32 lakhs, less than 40 lakhs unallowed. The company gets a further deduction of 8 lakhs for 32L in the year of sale. Scenario 2, sold for 43 lakhs, more than 40 lakhs unallowed. The excess is 3 lakhs, 43 or 40L. This 3 lakhs is taxable as business profit, Section 4A1, to applies here via 35(ab), as it's less than the 10 lakhs deduction already claimed. Scenario 3. Only 60% of the license is sold for 25 lakhs. The 25 lakhs proceeds reduce the unallowed expenditure. 40L 25 equals 15L. This remaining 15L is then amortized over the remaining 8 years. 15L 8 years.
That really clarifies how the sale proceeds interact with the unallowed expenditure and prior deductions. Very practical examples. H expenditure on specified business, Section 35 AD. Now let's turn to Section 35 AD. This section seems to offer a very significant deduction, effectively a 100% write-off of capital expenditure for certain types of businesses. This sounds like a major incentive.
It absolutely is. Section 35 AD provides a powerful incentive for investment in certain core infrastructure and development areas by allowing a 100% deduction for capital expenditure. It applies to an extensive list of specified businesses, including setting up and operating cold chain facilities, warehousing facilities for agricultural produce, laying and operating cross-country natural gas or crude petroleum oil pipeline networks, building and operating hotels, 2-star or above, building and operating hospitals with at least 100 beds, developing housing projects under slum redevelopment or affordable housing schemes, production of fertilizers in India, setting up inland container depots or freight stations, beekeeping and production of honeybees wax, warehousing facilities for sugar, laying slurry pipelines for iron ore transportation, setting up semiconductor wafer fabrication manufacturing units, developing or operating and maintaining new infrastructure facilities.
That's a very broad list covering key sectors. What's the deduction amount?
The quantum of deduction is 100% of the capital expenditure incurred wholly and exclusively for the specified business during the previous year. Again, this deduction excludes the cost of acquiring land, goodwill, or any financial instrument.
100% upfront, excluding land, goodwill, financial instruments. What about costs incurred before starting the business?
Capital expenditure incurred prior to the commencement of the specified business is also allowed as a deduction in the first year of commencement, provided it was incurred for the specified business and capitalized in the books of account on the commencement date.
Are there specific conditions to qualify for this 100% deduction?
Yes, there are crucial conditions for deduction, general conditions. The specified business should not be set up by splitting up or reconstructing an existing business. There's also a limit on using previously used machinery. Its value shouldn't exceed 20% of the total value of machinery used in the specified business. Imported secondhand machinery not previously used in India is considered new. Specific conditions. For businesses like pipelines or infrastructure facilities, there might be additional conditions like being owned by an Indian company or consortium, obtaining necessary approvals, for example, from Petroleum Natural Gas Regulatory Board, operating on a common carrier basis, or having an agreement with the government.
And how does claiming this big 35 AD deduction interact with other deductions or benefits in the Act?
This is vital for exam purposes and planning. The interaction with other sections is restrictive. If you claim the 100% deduction under Section 35 AD for a specified business, then no deduction is allowed under Section 10AA for SEZ units, or under Chapter 6A, which contains deductions like ADIA, ADIB for certain incomes for that same specified business for any assessment year. Conversely, if you claim a deduction under 10OA or Chapter 6A for a business, you cannot claim the 3580 benefit for it. You essentially have to choose which incentive route to take for that business. Furthermore, any expenditure for which a 100% deduction is allowed under 35AD cannot be claimed as a deduction under any other provision of the Income Tax Act. This prevents any form of double dipping.
So it's a powerful deduction, but you give up other potential benefits for that specific business. What about losses from these specified businesses?
That's governed by Section 73A. Losses computed for a specified business, after claiming the 100% 35AD deduction, can only be set off against the profits and gains of any other specified business. They cannot be set off against profits from non-specified businesses or other income heads.
That's quite restrictive for loss set-off.
It is. However, the significant advantage is that these specified business losses, if they cannot be set off, can be carried forward indefinitely to be set off against profits of any specified business in future years. Regular business losses typically have an 8-year carry-forward limit.
Indefinite carry-forward is a major plus, even with the restricted set-off. Let's go through some of the provided illustrations for Section 35 AD, illustrations 7, 8, and 9, to see these rules in action. They seem quite complex.
They illustrate the application well. Let's start with illustration 7, warehousing. Say a company runs 2 warehousing units, one for food grains, which is a specified business under 35 AD, and one for edible oils, which is not specified. For the food grain unit, the company can claim 100% of its capital expenditure, say on building construction, excluding land cost, under Section 35 AD. For the edible oil unit, it cannot claim 35 AD, so it would claim normal depreciation under Section 32 on its capital expenditure. Now, crucially, let's say the specified food grain business, after the 3580 deduction, results in a loss of 50 lakhs, while the non-specified edible oil business has a profit of 80 lakhs. The 50 lakh loss from the specified business cannot be set off against the 80 lakh profit from the non-specified business due to Section 73A. That 50 lakh loss must be carried forward indefinitely, only to be set off against future profits from other specified businesses, maybe a cold chain facility it sets up later. The company would pay tax on the 80 lakh profit from the edible oil business.
That perfectly illustrates the 3580 deduction itself and the strict loss set-off rule under 73A. What about illustration 9, asset use changed? This involves a deeming provision if an asset is used for other purposes later.
Right. Illustration 9 demonstrates the clawback, or deeming provision under Section 35AD7B. This applies if an asset for which a 100% deduction was claimed under Section 35AD is later used for any purpose other than the specified business within 8 years of its acquisition. In the year the usage changes, an amount is deemed to be business income. The calculation is total 3580 deduction originally allowed on that asset minus the notional depreciation that would have been allowed under Section 32 from the year of acquisition up to the year before the change, if no 3580 deduction had been claimed at all. This difference represents the excess deduction claimed up front, which is now added back to income because the asset is no longer exclusively used for the specified business.
So you lose part of the benefit retrospectively if the asset's use changes within 8 years. And how does this affect the asset's cost for future depreciation in the non-specified business?
Good point. This ties back to the definition of actual cost. The proviso to Explanation 13 to Section 43(1) states that the actual cost of this asset, when used for the non-specified business, will be the original cost reduced by the notional depreciation calculated for the deeming provision under 35AD7B. This ensures depreciation is calculated correctly going forward in the new business context.
Wow, that's intricate, but ensures the tax treatment aligns with the asset's actual use over time, even after claiming the initial 100% deduction. These illustrations are really key to understanding 35AD, contributions for rural development, Section 35 CCA.
Moving on, Section 35 CCA allows a deduction for sums paid to certain approved associations or institutions for carrying out rural development programs or notified conservation projects.
So incentivizing corporate participation in rural development.
Exactly. The crucial condition is that the association, institution, and the program must be approved and notified.
And how does this interact with the concessional tax regimes?
Similar to contributions for external scientific research, this deduction under 35 CCA is generally not available if you opt for the default tax regime, 115 BAC for individuals HUFs, or the special corporate cooperative society regimes, 115 BA Babad Bay. This reinforces the trade-off. Lower tax rate often means losing specific deductions. J. Expenditure on Agricultural Extension Project, Section 35 CCC. Section 35 CCC provides a deduction for expenditure incurred by an SSE on a notified agricultural extension project. This aims to encourage businesses to help with farmer training, education, and guidance.
Similar to rural development, but focused on agricultural know-how.
Yes, the project needs approval from the Ministry of Agriculture, and the expected expenditure should generally exceed 25 lakhs, excluding land building costs. The deduction is 100% of the eligible expenditure. You need separate books, an audit, and specific reporting for this.
And the tax regime impact.
Same restrictions apply as for 35 CCA, not available under the default special concessional tax regimes. K deduction for notified skill development project, Section 35 CCD. This section, 35 CCD, incentivizes companies to invest in skill development, particularly in the manufacturing or specified service sectors. A company can claim a 100% deduction for expenditure, excluding land building, incurred on a notified skill development project undertaken in accordance with prescribed guidelines. Reimbursed expenses are not eligible.
Focused on companies and skill building, any specific conditions?
Yes, the project must be notified. It should be undertaken by an eligible company in manufacturing or specified services. The training must generally be in separate facilities in a training institute. It excludes skill development for existing employees if training starts more than 6 months after their recruitment. Again, separate books, audit, and reporting are required.
Tax regime impact for companies.
This deduction under 35 CCD is not available to companies opting for the special concessional provisions under Section 115 BAA or 115 BAB. L. Amortization of preliminary expenses, Section 35D.
Okay, let's shift gears slightly. What about those costs incurred before a business even starts operations or before a major expansion? These preliminary expenses must be substantial sometime.
They can be, and Section 35D provides a mechanism to deduct them over time, rather than allowing them all up front or disallowing them as pre-commencement capital costs. This applies to Indian companies and resident non-corporate taxpayers. It covers specified expenses incurred before the commencement of a new business or in connection with the extension of an existing undertaking or setting up a new unit.
How does the deduction work?
The eligible preliminary expenditure is amortized. You get a deduction of 15th of the qualifying expenditure for 5 successive previous years, starting from the year the new business commences or the year the extension new unit is completed and starts production.
Spread over 5 years, what kind of expenses qualify?
There's an extensive list of eligible expenditure: preparation of feasibility reports, project reports, market surveys, engineering services related to the business, legal charges for drafting agreements between the SSC and others relating to the business setup. For companies, it also includes legal charges for drafting the memorandum and articles of association, MOA, printing costs for these, fees for company registration, and expenses related to public issue of shares or debentures, like underwriting commission, brokerage, prospectus costs.
That covers most typical startup or expansion costs. Are there limits on the total amount?
Yes, there are crucial overall limits on the aggregate amount of expenditure that can be amortized. For non-corporate assessees, maximum amount is 5% of the cost of the project. For Indian companies, maximum amount is the higher of 5% of the cost of the project, or 5% of the capital employed in the business. Cost of the project generally means the actual cost of the fixed assets, land, building, machinery, etc., associated with the new business or expansion as of the date of commencement completion. Capital employed for a company means it's issued share capital, debentures, and long-term borrowings as on that date.
So the deduction is capped relative to the project size or capital base?
Correct. And for non-company cooperative assessees cloning this, they need to get their accounts audited by a CA and furnish a report for the first year the deduction is claimed.
What happens in amalgamation or demerger?
The benefit passes on. If an Indian company which incurred these expenses merges or demerges, the successor company can claim the deduction for the remaining balance period. The original company doesn't get the deduction in the year of transfer. And importantly, like other specific deductions, if you claim amortization under 35D, you cannot claim the same expenditure under any other provision of the Act.
A relevant case law here is Free Cement Ltd v. CIT, right? What did that clarify?
Yes, that case clarified that share premium collected by a company is not part of capital employed for calculating the 5% limit under Section 35D. It only includes issued share capital, debentures, and long-term borrowings. That's a crucial point for calculating the maximum eligible amount for companies. Amortization of expense for amalgamation to merger, Section 35DD. Section 35DD specifically addresses the expenses incurred by an Indian company wholly and exclusively for the purpose of its own amalgamation with another Indian company or its own demerger.
So costs of the M&A transaction itself.
Exactly. The deduction mechanism is similar to 35D. 15th of such expenditure is allowed as a deduction for 5 successive years, starting from the year in which the amalgamation or demerger takes place. Again, no other deduction is allowed for this expense. And amortization of expenditure under voluntary retirement scheme, Section 35DDA.
Section 35DDA deals with a different kind of restructuring cost payments made under a voluntary retirement scheme, VRS. How is that handled?
If an assessee incurs expenditure in any previous year by way of payment to an employee in connection with their voluntary retirement under an approved VRS, that expenditure is amortized. The deduction allowed is 15th of the amount paid for 5 successive previous years, beginning with the year in which the payment was made.
Again, a 5-year spread. What if the business itself gets restructured after making VRS payments?
Similar to 35D and 35DD, if there's a business reorganization like amalgamation, demerger, firm succeeded by company, private company converted to LLP, the deduction for the remaining installments passes on to the successor entity. The predecessor doesn't get the deduction in the year of reorganization, and again, no other deduction allowed for this VRS expense. Amortization of expenses for prospecting and development of certain minerals, Section 35E. This Section 35E is specific to the mining industry. It allows for amortization of certain pre-production expenses.
Okay, what kind of expenses?
It applies to Indian companies or resident persons carrying on the business of prospecting for or extraction or production of certain specified minerals listed in the 7th Schedule of the Act. The eligible expenditure is that incurred wholly and exclusively on prospecting for those minerals or on developing a mine after the license is granted, but before commercial production starts.
So pre-production mining development costs, how is the deduction calculated?
The deduction is 110th of the specified eligible expenditure allowed for 10 successive previous years. The 10-year period starts from the year of commencement of commercial production. There's some flexibility. The assessee can choose which block of 10 years to claim it in, within limits.
10-year amortization for mining. And an amalgamation to merger.
The deduction continues for the amalgamated or resulting company for the remainder of the 10-year period. No other deduction is allowed for these expenses. P. Other deductions, Section 36.
All right, we've covered amortization and special industry deductions. Now we come to Section 36, which seems like a collection of very specific, common business deductions. Let's go through some key ones.
Yes, Section 36 lists several specific deductions allowed while computing business income. Let's highlight the most impactful. Insurance premium, Section 36(1)(b). You can deduct the premium paid for insurance against risk of damage or destruction of stock or stores used for your business. Also, premiums paid by an employer, must be by non-cash mode, for their employees' health insurance under an approved scheme are deductible.
Health insurance for employees is deductible. Good incentive.
Bonus and commission, Section 36(1)(2). Payments of bonus or commission to employees are deductible, provided the sum paid would not have been payable to them as profits or dividends if it hadn't been paid as bonus commission. This acts as a safeguard against distributing profits disguised as bonus. Remember the Shasun Chemicals case law we mentioned earlier? It clarified that payment via a trust to employees before the due date is allowable.
Right, substance over form for payment timing.
Interest on borrowed capital, Section 36(1)(3). This is a major one. Interest paid on capital borrowed for the purpose of the business or profession is deductible. The scope is very wide. The borrowing must be linked to business needs. However, there's that crucial proviso we touched upon under actual cost. Any interest paid on a loan taken to acquire an asset, capital, or revenue that relates to the period from the date the loan was taken until the date the asset was first put to use is not allowed as a deduction under this section. It must be capitalized as part of the asset's cost.
So pre-operational interest gets added to the asset cost, not deducted here.
Correct. Importantly, case laws like CIT v. Gujarat Guardian Ltd. and Taparia Tools Ltd. v. JCIT have established that certain upfront interest payments, like those for debenture issuance or loan restructuring, even if amortized in the books over the loan period, might be deductible in full in the year of actual payment under Section 36. Off you one. Especially when read with Section 43B, which mandate deduction on actual payment for interest. This is a significant point where tax treatment can differ from accounting.
Full deduction in year of payment for certain upfront interest costs, despite accounting amortization. That's key.
Contributions to Provident and other funds, Section 36(1). Employers' contributions towards a recognized Provident fund or an approved superannuation fund are deductible, subject to certain limits and conditions specified in the Act. Contribution to pension scheme, Section 36(1). Employers' contribution to a notified pension scheme, like the National Pension System, NPS, is deductible up to 10% of the employee's salary, basic plus DA. For central state government employees, this limit is higher in 14%.
NPS contributions up to 10% or 14% of salary are deductible for the employer.
Bad debts, Section 36(1) hence. Read with Section 36(2). This allows a deduction for debts that become irrecoverable. The conditions are: the debt must be incidental to the business or profession carried on by the assessee. The debt must have been taken into account in computing the income of the assessee in the current or an earlier year, or it represents money lent in the ordinary course of banking money lending business. Crucially, the debt must be written off as irrecoverable in the assessee's books of account for that previous year.
So it must be related to business, previously offered to tax, or be from lending business, and actually written off in the books.
Yes. There's an important interaction with the provision for bad and doubtful debts, Section 36(1), for banks and certain financial institutions. For them, the deduction for bad debts actually written off under 36(1) is limited to the amount by which the bad debt exceeds the credit balance sitting in their provision for bad debts account created under 36(1).
Okay, so the provision reduces the direct write-off deduction for banks.
Correct. A significant ICDS impact also comes from the second proviso to 36. It says that if a debt was not recognized in the books of account initially, as per accounting policy, but was taken into account for income computation as per ICDS, for example, accrued income under mercantile system taxed as per ICDS 4, and this debt later becomes irrecoverable, it is deemed to have been written off and is allowed as a bad debt deduction under 37. This helps align tax treatment with ICDS income recognition.
That's important for reconciling differences between book accounting and ICDS for income.
Provision for bad and doubtful debts, Section 36(1)(b). This section allows a deduction for the provision itself, not just actual write-offs, created by scheduled banks, non-scheduled banks, public financial institutions, state financial corporations, NBFCs, etc. The amount is limited based on percentages of total income and aggregate average rural advances for banks, plus an optional provision for assets classified as doubtful loss by RBI.
So banks get a deduction for the provision too, subject to limits.
Special Reserve, Section 36(1)(8). This allows a deduction for amounts transferred to a special reserve created by specified financial corporations involved in long-term finance for industrial, agricultural development, housing, or banking companies providing long-term finance for infrastructure or housing. The deduction is limited to the least of amount transferred, 20% of eligible business profits, or a cap linked to paid-up capital and existing reserves. This incentivizes creation of reserves for long-term lending.
But withdrawals are taxed, right?
Yes, as we discussed under Section 41(4)(a), any amount later withdrawn from this special reserve is deemed business profits and taxed. Securities Transaction Tax, STT, Section 36(1)(15), and Commodities Transaction Tax, CTT, Section 36(1). STT or CT paid by the assessee on taxable securities transactions or commodities transactions is allowed as a deduction, provided the income from such transactions is included under the head Profits and Gains of Business or Profession.
So if you're a trader, the transaction taxes are deductible business expenses.
Correct. Finally, mark-to-market loss, Section 36(1). This allows a deduction for mark-to-market MTM losses or other expected losses only if they are computed in accordance with notified ICDS. As we saw, ICDS INA generally prohibits recognizing expected losses unless permitted by another ICDS. So effectively, only MTM losses specifically allowed under other ICDSs, like potentially under ICDS 8 for securities or ICDS 6 for Forex, can be claimed here.
So a very restricted allowance for MTM losses tied strictly to ICDS permissions. Q general deductions, Section 37. Okay, after that exhaustive list of specific deductions in Section 36 and elsewhere, we arrive back at Section 37, the catch-all or residuary section we mentioned earlier. This is for legitimate business expenses not covered anywhere else, right?
That's exactly right. Section 37(1) is the fallback provision. It allows a deduction for any expenditure which meets these conditions. It should not be expenditure of the nature described in Sections 30 to 36. It should not be in the nature of capital expenditure. It should not be personal expenses of the SSC. It must have been laid out or expended wholly and exclusively for the purposes of the business or profession.
Wholly and exclusively for the purposes of the business. That's the key test here.
It is. It requires a direct nexus between the expenditure and the business activity. For example, the premium paid by a firm on a Keyman insurance policy, taken out on a partner, intended to compensate the firm for potential business loss if the partner dies, has been held to be admissible expenditure under Section 37 as it's for business purposes.
Now, a crucial aspect of Section 37(1) is what it specifically disallows. There are important explanations here.
Yes. Explanation 1 and 3 are critical disallowance provisions. They explicitly state that any expenditure incurred by an SSC for any purpose which is an offense or which is prohibited by law, whether in India or outside India, shall not be deemed to have been incurred for the purpose of business or profession, and thus no deduction shall be allowed.
So payments for legal acts are out.
Completely out. This includes providing any benefit or perquisite to a person, like the freebies to doctors by pharma companies we discussed under the CAPSCAN case, if the acceptance of such benefit violates any law, rule, regulation, or guideline governing that person's conduct. Expenditure incurred to compound an offense or settle proceedings for contravention of any notified law. Case laws confirm this. Payments to police gundas, Dilavati case, are illegal bribes and not deductible. Regularization fees for violating building bylaws, Millennia Developers case, are penalties for infraction of law and not deductible.
The law won't subsidize illegal activities or penalties. Makes sense. What about CSR expenditure?
That's covered by Explanation 2 to Section 37(1). It clarifies that any expenditure incurred by an SSC on activities relating to corporate social responsibility, CSR, as referred to in Section 135 of the Companies Act, 2013, shall not be deemed to be expenditure incurred for the purposes of business or profession. Therefore, it is disallowed as a deduction under Section 37(1).
So mandatory CSR spend is disallowed under the general Section 37.
Correct. The rationale often cited is that it's considered an application of income, not an expense to earn income. However, there's a very important nuance here. The explanation only disallows it under Section 37(1). If a CSR expenditure happens to be of the nature described in Sections 30 to 36, for example, a contribution to an approved scientific research association under S35, which also qualifies as CSR, then it will be allowed as a deduction under that specific section, as for 3.5 in this example, provided the conditions of that section are met.
So the nature of the CSR expense matters. If it fits under another specific deduction section, it can still be claimed there. That's a vital distinction.
It really is.
Yeah.
Section 37 also specifically disallows expenditure on advertisements and political party souvenirs. Section 37(2)(b). And interestingly, for the film industry, Rule 9A clarifies that expenditure incurred on a feature film that is ultimately abandoned without completion is treated as revenue expenditure and allowable under Section 37 in the year of abandonment.
That clarifies treatment for abandoned projects in that specific industry. What about BOT, build, operate, transfer projects for road highways? You mentioned a clarification.
Yes, the CBDT issued a circular cost clarifying the treatment. Since the developer in a typical BOT model doesn't own the underlying asset, they usually have possession and right to operate, but ownership remains with the government. Depreciation under Section 32 is not allowed on the construction cost. Instead, the circular states that the cost of construction, including eligible preoperative expenses capitalized, should be amortized evenly over the period of the concessionaire agreement, excluding the time taken for construction.
Yeah.
This amortization is allowed as a deduction under Section 37.
So amortization over the concession period under Section 37, not depreciation under Section 32, for BOT road projects. Highly specific and important for infra players.
Precisely. Let's bring all these deduction concepts together with a comprehensive example. Illustration 11, page 3.129, shows how to compute taxable business income by adjusting net profit for various debited items. Can you walk us through the adjustments?
Sure. This illustration is excellent for seeing the practical application. You start with the net profit as per the profit and loss account. Then you need to make adjustments. Add back disallowed expenses. Add back disallowed expenses. Advertisement in a political party souvenir disallowed under 37(2)(b). Add back disallowed expenses. Expenses of capital nature, like costs for issuing right shares. Add back disallowed expenses. Penalties paid for infraction of law, for example, GST penalty. Add back disallowed expenses. Interest paid on a loan taken specifically to pay advance income tax, considered personal, not business. Add back disallowed expenses. Provisions for potential future losses, like provision for loss of subsidiary, these are only deductible when the loss actually materializes. Ensure correct deduction claimed for allowed items. Scientific research. If capital expenditure on land was debited, add it back as land is excluded. Ensure 100% of other eligible capital and revenue R&D spend is deducted, if not already fully debited. Check treatment under 35(2)(a)(b) versus 35(1) if applicable. Agricultural extension skill development. Similarly, ensure land building costs are excluded if deduction claimed under 35 CCD. Deduct the eligible amount if not fully debited. Consider ICDS adjustments. If ICDS requires different income recognition or expense treatment compared to books, make necessary adjustments.
Exactly. By systematically reviewing the P&L debits, identifying disallowed items, correcting the amounts for specifically allowed deductions, like R&D, ensuring exclusions like land are handled, and considering any ICDS impacts, you arrive at the final taxable profits and gains from business or profession. It's a process of refinement for the book profit. 7. Inadmissible deductions, Section 40.
We've covered what can be deducted in great detail. Now let's flip the coin again and focus specifically on Section 40, which lists amounts that are not allowed as deductions or are disallowed under certain circumstances. These are crucial for compliance, aren't they?
Absolutely. Section 40 contains some very significant disallowances, often related to TDS compliance or payments within firms. One major category relates to the non-deduction or non-payment of tax deducted at source, TDS, or equalization levy. Payments outside India to a non-resident or foreign company, Section 40AI. If you are required to deduct TDS on payments like interest, royalty, fees for technical services, or any other sum chargeable to tax in India, and you pay to a non-resident without deducting TDS, or after deducting you fail to pay to the government on or before the due date for filing your income tax return under Section 139(1), then the entire 100% of that expenditure is disallowed.
100% disallowance for non-compliance on payments to non-residents. That's harsh. Is there relief if you pay later?
Yes, if you pay the TDS in a subsequent year, the expenditure is allowed as a deduction in that subsequent year, the year of payment. Remember the Murray Suzuki case, though it provided an exception where no disallowance applies if the non-resident's income wasn't chargeable to tax in India in the first place.
Okay. What about payments to residents?
30% of sum payable to a resident, Section 40. For payments made to residents on which TDS is required, like interest, commission, brokerage, rent, fees for professional technical services, payments to contractors, if you fail to deduct TDS or after deducting fail to pay it by the return filing due date, then 30% of such sum is disallowed.
So 30% disallowance for resident payments compared to 100% for non-residents. Still significant.
Very significant. And again, if you pay the TDS later, the 30% disallowed amount is allowed as a deduction in the year of payment. A clarification confirmed this disallowance applies to all sums payable on which tax is deductible, whether actually paid during the year or just accrued and payable at year-end.
To illustrate the 30% rule, if a company accrues 10 lakh commission payable to a resident agent but fails to deduct or pay TDS by the due date, 3 lakh, 30% of 10 lakh, will be disallowed when computing the company's income.
Precisely. There's a similar 100% disallowance under Section 40AA for non-deduction or non-payment of the equalization levy on consideration paid to a non-resident for specified digital services. Other general disallowances under Section 40 include any rate or tax levied on profits, Section 40A2, income tax itself, including foreign taxes eligible for credit, super tax, wealth tax, etc., are not deductible. They're considered an application of profits, not an expense incurred to earn them. Tax paid by employer on non-monetary purposes, Section 40A. If an employer pays the tax on behalf of an employee for non-monetary perks, which is exempt for the employer cannot claim that tax payment as a deductible business expense.
Okay, tax on tax isn't deductible. Now, a really critical area under Section 40 is payments between a firm and its partners, Section 40B.
Yeah.
What are the key disallowances here?
Section 40B is extremely important for partnership firms. It imposes specific limits and conditions on deducting payments of interest and remuneration made to partners. Disallowances occur if remuneration is paid to a non-working partner, defined as someone not actively engaged in conducting the firm's affairs. That's fully disallowed. Any remuneration or interest is paid which is not authorized by or is inconsistent with the terms of the partnership deed. The payment must be explicitly permitted by a valid current deed. Payment relates to a period prior to the date of the partnership deed authorizing it. You can't authorize payments retrospectively before the deed existed. Interest paid to any partner exceeds 12% per annum simple interest. The excess over 12% is disallowed. Remuneration paid to working partners exceeds the prescribed limits based on the firm's book profit.
Those limits on working partner remuneration are quite specific, right? How do they work?
They are. The maximum allowable remuneration is calculated in 2 tiers based on the firm's book profit. On the first 3 lakh of book profit, or in case of a book loss, allowable remuneration is the higher of $1,050,000 or 90% of the book profit. Note, the $1,050,000 floor ensures some deduction even with low profits or losses. On the balance of the book profit, above 3 lakh, allowable remuneration is 60% of the balance book profit. Book profit itself is defined in Explanation 3 as the net profit shown in the P&L account computed according to business income rules, but before deducting partner remuneration and after deducting partner interest, up to 12%. Essentially, you calculate profit before partner salary, then apply the limits to find the maximum deductible salary.
Let's take an example. Illustration 15 shows a firm with net profit of $1,010,000 after debiting partner salaries, $1,080,000, and partner interest, $35,000, which is within 12%. How do we find allowable remuneration?
Okay, first find the book profit. Start with net profit, $1,010,000. Add back the remuneration already debited, $1,080,000. The book profit is $2,090,000. Now apply the limits to this $2,090,000 book profit. Since the book profit is less than 3 lakh, the limit is the higher of $1,050,000 or 90% of $2,090,000, $2,061,000. The higher figure is $2,061,000. The firm actually paid $1,080,000, which is less than the limit of $2,061,000. Therefore, the entire $1,080,000 paid is allowable as deduction.
Okay, so the calculation involves finding book profit first, then applying the tiered limits, 90% with the floor, to find the maximum allowable and comparing that to what was actually paid.
Exactly. If they had paid, say, $3,000 remuneration, only $2,061,000 would be allowed, and the excess $39,000 would be disallowed under 40B.
Finally, what about payments by an AOP BOI to its members?
Section 40B provides a blanket disallowance. Any payment of interest, salary, bonus commission, or remuneration by an association of persons, AOP, or body of individuals, BOI, to its members is not allowed as a deduction when computing the income of the AOP BOI. 8. Expenses or payments not deductible in certain circumstances, Section 40A.
Beyond the general disallowances in Section 40, Section 40A introduces further specific restrictions. These often seem aimed at preventing artificial reduction of taxable income, especially through related party transactions or large cash payments, right?
That's a good summary. Section 40A acts as an overriding section. Its provisions apply notwithstanding anything else in the Act regarding computation of business income. One key provision is excessive or unreasonable payments to relatives or specified persons, Section 40A2. If you incur an expenditure for which payment is made or to be made to a specified person, this definition is very broad, including relatives, directors, partners, persons with substantial interest, 20% voting power or profit share, and related companies. That expenditure can be disallowed by the assessing officer to the extent he considers it excessive or unreasonable.
How is excessive or unreasonable judged?
It's judged having regard to the fair market value of the goods, services, or facility for which the payment is made, the legitimate needs of your business or profession, the benefit derived by or accruing to you from the expenditure. This prevents shifting profits to related parties through inflated payments for goods or services.
Okay, a reasonableness check for related party payments. Now, a very significant rule. Payments exceeding $10,000 made otherwise than through prescribed modes, Section 48.3. We touched on this for actual cost, but it applies to general revenue expenditure too, right?
Yes, and it's critical for day-to-day operations. The general rule under Section 48.3, if you incur any expenditure which is otherwise allowable as a deduction, but you make a payment or aggregate of payments towards that expenditure to a single person in a single day exceeding $10,000, and the payment is not made by an account pay check, account pay bank draft, or prescribed electronic modes like ECS, credit debit card, net banking, MPS, UPI, RTGS, NEFT, BHIM, Otter Pay, then the entire expenditure related to that payment is disallowed.
The entire expenditure, not just the amount over $10,000.
Yes, the entire expenditure linked to that non-compliant payment or aggregate of payments for the day. For example, if you buy goods worth $32,000 and pay the supplier in 4 cash installments of $8,000 on the same day, the entire $32,000 purchase cost could be disallowed because the aggregate cash payment to that person that day exceeded $10,000.
That's a very strict rule promoting cashless transactions. What if you claim the expense in 1 year but paid it in cash over the limit next year?
That's covered by Section 48.3a. If an expenditure was allowed as a deduction in one assessment year, say on accrual basis, but in a subsequent year you make a payment exceeding $10,000 in cash or non-prescribed mode towards that liability, then the amount of that payment is deemed to be income chargeable under profits and gains in the year the payment is made. It effectively reverses the earlier deduction.
A clawback through deemed income, is the limit always $10,000?
There's one main exception. For payments made for plying, hiring, or leasing goods carriages, the limit is higher at $35,000 per day per person.
Okay, $35,000 for transport operators. Are there other exceptions where cash above $10,000 is allowed?
Yes. Rule 60D provides a list of crucial exceptions where Section 48.3 disallowance does not apply, even for cash payments above the limit. Some key ones include payments made to the government, RBI, banks like SBI, cooperative banks, land mortgage banks, primary agricultural credit societies, or LIC, payments made for the purchase of agricultural or horticultural produce, livestock, fish, or fish products directly to the cultivator, grower, or producer of such items. This doesn't cover payments to traders' middlemen. Payments made for products manufactured without power in a cottage industry to the producer. Payments made in a village or town which, on the date of payment, is not served by any bank. Payments of salary to an employee after deducting TDS if the employee is temporarily posted for 15 days or more away from their normal place of duty or a ship and doesn't have a bank account accessible there. Payments required on a day when banks were closed due to holiday or strike. Payments made by an authorized dealer or money changer for purchase of foreign currency.
That list in Rule 60D is vital for practical application, covering unavoidable cash payment scenarios.
Absolutely. Knowing Rule 60D exceptions is key to avoiding inadvertent disallowance under 48.3.
What about provision for gratuity, Section 40A7?
This section states that, generally, no deduction is allowed for any provision made by an assessee for the payment of gratuity to their employees on retirement or termination. The rationale is that a deduction should only be allowed when the liability is discharged. So gratuity is deductible only when the gratuity is actually paid to the employees during the year, OR. Contributions are actually made by the employer towards an approved gratuity fund during the year.
So no deduction for just creating a provision in the books? Only actual payment or contribution to an approved fund counts.
Precisely. It prevents deductions based on mere book entries that might not result in actual outflow for years. If a provision was allowed in the past under specific exceptions, then the actual payment made later out of that provision is not allowed again.
Okay. And contributions to unrecognized funds, Section 40A9.
Section 40A9 provides a general disallowance for any sum paid by the assessee as an employer towards setting up or contributing to any fund, trust, company, AOP, BOI, or society established for employee welfare, like Provident Fund, Superannuation Fund, gratuity fund, unless such contribution is specifically allowable under provisions like Section 36(1) or V for recognized P-approved superannuation gratuity funds, or is required by any other law. This prevents deductions for contributions to unapproved or unrecognized welfare funds.
Makes sense. Finally, mark-to-market loss, Section 4813.
This section reinforces what we saw under Section 36. It explicitly states that no deduction shall be allowed for any mark-to-market loss or other expected loss, except as specifically allowable under Section 36 itself, which, as we discussed, links back to losses permitted under specific ICDS. This acts as a definitive statement against allowing general MTM or expected losses not sanctioned by ICDS. 9. Deemed profits, Section 41.
We've talked a lot about deductions and disallowances. Now let's look at Section 41, which deals with deemed profits. This is where certain receipts or events, which might not seem like normal business income, are specifically treated as taxable business profits. It's like a clawback mechanism, isn't it?
That's a very good way to put it. Section 41 essentially brings amounts back into the tax net when a previous deduction or allowance granted is effectively reversed or nullified by subsequent events. It prevents assessees from getting away with a past tax benefit that is no longer justified. The most common one is remission or cessation of trading liability. Section 41. If you had claimed a deduction in an earlier year for any loss, expenditure, or trading liability, say you accrued an expense payable to a supplier and claimed it, and then in a later year, you obtained some benefit in respect of that trading liability by way of remission, waivers, or cessation thereof, liability no longer exists, then the value of the benefit accruing to you is deemed to be profits and gains of business or profession and is taxed in the year you obtain this benefit.
So, if a supplier waives a debt for which I already claimed an expense deduction, that waived amount becomes my taxable income.
Exactly. This even includes situations where the assessee unilaterally writes back such a liability in their own accounts, indicating it's no longer payable. The key is that a deduction was allowed earlier for that liability.
Okay, that makes sense. What are the other deemed profit scenarios under Section 41?
There are a few others. Balancing charge, Section 412. This primarily applied to undertakings engaged in power generation distribution under the old system, where depreciation was calculated on individual assets, not blocks. If such an asset, building, machinery, plant, furniture, was sold, discarded, demolished, or destroyed, and the money received exceeded its written-down value, the excess was deemed business income, up to the difference between original cost and WDV, essentially recouping depreciation claimed. This is less relevant now with the block system, but the principle remains. Sale of capital asset used for scientific research, Section 41.3. As we discussed under Section 35, if a capital asset used for scientific research, on which 100% deduction was claimed, is sold, the lower of the sale proceeds or the deduction allowed earlier is deemed business income under this section. Recovery of bad debt, Section 41.4. If you had claimed a deduction for a bad debt under Section 36 in an earlier year, and you subsequently recover any amount in respect of that debt, whether fully or partially, the amount recovered is deemed to be business income of the year in which it is recovered. Withdrawal from special reserve under Section 36(1), Section 41.4a. As mentioned earlier, if an amount for which deduction was allowed under 36 for financial corporations creating special reserves is later withdrawn from that reserve, the amount withdrawn is deemed to be business profits of the year of withdrawal.
So these provisions essentially reverse the tax benefit of earlier deductions when the underlying basis for that deduction changes, liability ceases, assets sold, debt recovered, reserve withdrawn.
Precisely. Section 41 ensures that the overall tax treatment reflects the final outcome of the transaction or situation for which a deduction was initially granted. X. Other important provisions.
Okay, we've covered the core computation, deductions, disallowances, and deemed profits. Now let's look at some other important provisions scattered between Sections 42 and 44 DB that deal with specific situations or overriding rules impacting business income computation. H. Maintenance of books of account, Section 44A. We touched on this briefly, but let's revisit the requirements for maintaining books of account under Section 44AA. Who needs to keep books and what kind?
Section 44AA mandates maintenance of books for various categories of taxpayers carrying on business or profession. Specified professions like legal, medical, engineering, accountancy, architecture, etc. If their gross receipts in the profession exceed $1,050,000 in all 3 immediately preceding years, or likely to exceed 1.5 lakh in the first year for a new profession, they must maintain such books of account and other documents as may enable the assessing officer to compute their total income. Rule 6F prescribes specific books like cash book, journal, ledger, copies of bills, original bills for expenses 50, and for medical professionals, additional records like patient registers. Other assessees carrying on business or profession, not specified. If it's an individual or HUF, they need to maintain books if their income from business profession exceeds 2,050,000 DLs, or their total sales turnover or gross receipts exceed 25 lakhs in any one of the 3 immediately preceding years, or likely to exceed these limits in the first year. If it's other than individual HUF, example, company firm, they need to maintain books if their income exceeds 1,020,000 or their total sales turnover gross receipts exceed 10 lakhs in any one of the 3 preceding years. Assessee is under presumptive taxation, 4040 FEA, if they claim their income is lower than the deemed profit under the presumptive scheme, FUG less than 8 or 6% under 44AD or less than 50% under 44ADA, and their total income exceeds the basic exemption limit, the threshold below which tax is not payable, then they must maintain books of account. Also remember the 5-year rule under 44AD. If you opt out after opting in, you generally need books for the next 5 years if income exceeds basic exemption.
So the requirement depends on the type of SSC, the nature of activity, specified profession versus other, and the level of income or turnover receipts. And opting out of presumptive tax below the threshold triggers the need for books.
Exactly. The books required for non-specified professions or businesses, where Rule 6F doesn't apply, should be such as to enable the AO to compute the total income according to the Act, implying standard accounting records are needed. Say, Audit of Accounts, Section 44AB.
Following maintenance of books, when does a business or profession need to get its accounts audited by a chartered accountant specifically for tax purposes? This is the tax audit under Section 44AB, right?
Yes, Section 44AB mandates a compulsory tax audit in certain situations. The requirement triggers if the turnover or gross receipts exceed specified thresholds, or if you opt out of presumptive taxation under certain conditions. The main scenarios are for a business. If total sales, turnover or gross receipts from the business exceed 1 crore in any previous year. Increased threshold. This 1 crore limit is increased to 10 crore if the aggregate of all cash receipts during the year does not exceed 5% of total receipts, and the aggregate of all cash payments does not exceed 5% of total payments. This strongly incentivizes shifting to digital transactions. Increased threshold. If an assessee is eligible for presumptive taxation under Section 44 AD but claims their profit is lower than the deemed profit, 8 per 6%, and their total income exceeds the basic exemption limit. Under the 44 AD flock-in rule, if an assessee declared profit under 44 AD in 1 year, but then in any of the next 5 consecutive years declares profit lower than the presumptive rate, they become ineligible for 44 AD for the next 5 years.
During this period of ineligibility, if their total income exceeds the basic exemption limit, they must get their accounts audited under 44AB. For a profession, if gross receipts from the profession exceed 50 lakhs in any previous year, increased threshold, this 50 lakh limit is increased to 75 lakhs if the aggregate of all cash receipts during the year does not exceed 5% of total gross receipts. Note, there's no condition on cash payments here, unlike for business. Increased threshold. If an SSC is eligible for presumptive taxation under Section 44 ADA, but claims their profit is lower than the deemed profit, 50%, and either total income exceeds the basic exemption limit. Crucially, if they declare 50% or more under 44 ADA, audit under 44 AD is not required just because receipts exceed 50L75 AT.
So the thresholds are 1 CR, 10 CR for business, and 50L 75 LRs for profession, with the higher limits linked to low cash transactions. And opting out of presumptive schemes below the deemed profit level also triggers audit if income is above basic exemption.
Precisely. If an assessee is already required to get their accounts audited under another law, like under the Companies Act, they don't need a second audit for tax purposes. They just need to furnish the tax audit report in the prescribed form, 3CA, 3CV, and 3CD.
What's the consequence of not getting the audit done?
Failure to comply with Section 44AB attracts a penalty under Section 271B. The penalty is the lower of 0.5% of the total sales, turnover, or gross receipts, or are 1,050,000. However, no penalty is levied if reasonable cause for the failure is proven. J. Special Provisions for Presumptive Taxation, Sections 44 AE.
Let's dive a bit deeper into these presumptive taxation schemes. They are designed as a simplification measure for small businesses and professionals, allowing them to declare income at a prescribed rate without detailed bookkeeping. Can you compare the main schemes, 44AD, 44AD, and 44E?
Certainly. They cater to different types of small taxpayers and have different rules. Section 44 AD for eligible businesses. Who's eligible? Resident individuals, HUFs, and partnership firms, but not limited liability partnerships LLPs. What business? Any business whose total turnover or gross receipts in the previous year does not exceed 2 crore. This limit is increased to 3 crore if aggregate cash receipts are 5% or less of total turnover receipts. Excluded businesses. It does not apply to persons carrying on professions covered under 44AD, those earning commission brokerage income, agency businesses, or those in the business of plying, hiring, or leasing goods carriages covered by 44AB. How much income? Deemed profit is 8% of the total turnover or gross receipts. However, if turnover receipts are received via account pay, check draft, or prescribed electronic modes during the previous year or before the return filing due date for that year, the deemed profit rate for that portion is lower at 6%. Benefits. If you opt for 44AD, you are not required to maintain books of account under 44A or get them audited under 44AB for that business. All deductions under sections 30 to 38 are deemed to have been allowed.
WDV of assets used in the business is calculated as if depreciation has been claimed and allowed. Key restriction, 5-year rule. If you opt for 44AD in a year, but then in any of the next 5 consecutive assessment years you declare profits lower than the 8 per 6% rate and your income exceeds basic exemption, you become ineligible to opt for 44AD for the following 5 assessment years. You'll likely need books and audit during this period if income exceeds basic exemption. Advanced tax. You need to pay the entire advanced tax liability in a single installment by March 15th of the financial year.
That 5-year lockout for opting out is a really important factor to consider before choosing 44AD.
It absolutely is. Let's look at illustration, page 3.184 from Mr. A. He opts for 44AD in AY 2526. In AY 2627, his turnover is 1.9 CR, presumptive profit is 15.2 Lidls, 8%, but he declares only 10L, which is above basic exemption. Because he declared lower than 8%, he is barred from using 44AD for the next 5 AYs, 2728 to 3132. For AY 2627 itself, you must maintain books and get audited.
That clarifies the rule perfectly. Now, what about Section 44AD for eligible professionals?
Section 44ABD. Who's eligible? Resident individuals or partnership firms, excluding LOPs, engaged in professions specified under Section 44AA1, legal, medical, engineering, accountancy, architecture, interior decoration, technical consultancy, film artists, or other notified professionals. Threshold. Total gross receipts must not exceed 50 lakh in the previous year. Increase to 75 lakh if aggregate cash receipts are 5% or less. How much income? Deemed profit is 50% of the total gross receipts from the profession. Benefits. Similar to 44AD, no requirement to maintain books under 44AA or audit under 44AB if declaring 50% or more. All deductions deemed allowed. WDV calculated notionally. Opting out. If you claim profits are lower than 50% and income exceeds basic exemption, you need to maintain books, 44AA, and get audited, 44AB. There is no 5-year lockout rule like in 44AD, advanced tax, entire amount by March 15th.
So 50% presumptive rate for specified professionals with receipts up to 50L, 75L, and no 5-year lockout if they opt out. That's simpler. Finally, Section 44AE for goods carriages.
Section 44AE. Who's eligible? Any assessee, individual, firm, company, etc., who owns not more than 10 goods carriages at any time during the previous year and is engaged in the business of plying, hiring, or leasing such carriages. How much income? Deemed income is calculated per vehicle per month, or part of a month, during which the vehicle is owned by the assessee. For heavy goods vehicles, gross weight 12,000 kilograms, 1,000 per ton of gross vehicle weight, or unladen weight for tractors, road rollers. For other goods vehicles, 7,500 per vehicle. Benefits. If you opt for 44AE, no need for books, 44AA, or audit, 44AB. Deductions under 3038 deemed allowed, exception for firms. For partnership firms opting for 44AE, deduction for interest and salary paid to partners is still allowed separately, subject to the limits under Section 40B. This is different from 44A where everything is deemed included. Opting out. If you claim lower profit than the deemed amount, you must maintain books and get audited. Advanced tax payable in regular installments, June 15, Sep 15, December 15, March 15.
So 44AE has a per vehicle calculation, allows partner remuneration deduction for firms, and has normal advanced tax deadlines. 3 distinct schemes tailored for different small business segments. Act AI, computation of business income, partly agricultural and partly business. Now, let's address a unique situation. Income that is partly agricultural, which is generally exempt from central income tax, and partly from business, which is taxable. How does the law handle this composite income, especially for processed agricultural products?
This arises when an assessee is involved in both growing an agricultural product and then processing it further before selling. The income tax rules provide specific methods to bifurcate the income into agricultural and business components for certain commodities. Rule 7A. Rubber. If you grow rubber plants in India and derive income from selling centrifuged latex or other processed forms like crepe rubber, 35% of the income derived from such sale is deemed to be taxable business income, and the remaining 65% is treated as agricultural income, exempt. Rule 7B. Coffee. If you grow coffee in India and sell it after curing, 25% of the income is business income, 75% is agricultural. If you grow coffee in India and sell it after curing, roasting, and grounding, with or without mixing chicory. 40% of the income is business income, 60% is agricultural. Rule 8. Tea. If you grow tea in India and manufacture it, process the leaves before selling. 40% of the income derived is business income, and 60% is agricultural.
So specific percentages, 35-65 for rubber, 25-75 or 40-60 for coffee, 40-60 for tea, are used to split the income from these integrated operations.
Exactly. These rules provide a clear basis for apportionment. It's important to note that for these rules to apply, the initial growing operation must happen in India. Illustration 21 highlights this. If someone grows coffee in Brazil, processes it there, and sells it in India, the entire income would be business income, assuming they are resident in India. The apportionment rules only apply when the growing happens in India.
That's a key condition. What about income from selling saplings or seedlings?
The illustration also clarifies this based on Explanation 3 to Section 21A. Income derived from saplings or seedlings grown in a nursery is considered 100% agricultural income, provided the basic operations like soil preparation, germination, were carried out on land. So nursery income is generally fully exempt.
Okay, so specific rules for rubber, coffee, tea grown and processed in India, and nursery income being fully agricultural. That clarifies the composite income situation. 12. Significant select cases, judicial interpretations. Finally, let's touch upon some significant court cases. What's fascinating here is seeing how judicial interpretations shape the understanding and application of these tax laws. These case laws provide essential context and often clarify ambiguities, which is vital for application-based understanding, isn't it?
Absolutely. Court decisions often delve into the why behind a provision or test its boundaries in real-world scenarios. They are crucial for a deeper comprehension. Let's look at a few key ones related to business income. Cases like Chennai Properties and Investments Ltd. CIT tackle the common issue of whether rental income should be taxed as income from house property or as profits and gains of business or profession. The Supreme Court held that if letting out properties is the main object of a company and it's carrying it out as its business activity, then the rental income can be assessed as business income. It depends on the facts and the company's primary purpose.
So, the nature of the assessee and their main activity matters for classifying rental income.
Yes. Then, in CIT v. K&Co., the issue was interest earned on margin money deposited for obtaining a bank guarantee, which was necessary for a business contract. The court ruled this interest was taxable as business income, not income from other sources. Why? Because the deposit was inextricably linked to the business operation. Without it, the business contract couldn't happen.
The direct link to business made the interest business income. Makes sense? What about depreciation claims?
ICDS Ltd v. CIT dealt with depreciation on vehicles given on lease. The court held that the lessor, the leasing company, is entitled to depreciation, even if the vehicle is registered in the lessee's name under the Motor Vehicles Act. The key conditions ownership, lessor retains ownership, and use for business, lessor uses assets in its leasing business, were met. This reinforces the concept of beneficial ownership and usage for depreciation.
So a registration name isn't the deciding factor for depreciation and leasing?
Correct. Regarding capital versus revenue expenditure under Section 37, CIT v. Orient Ceramics and Industries, Ltd., held that expenditure on glow sign boards displayed at dealer premises was revenue in nature if it didn't result in an enduring benefit of a capital nature for the assessee. It was seen more as advertising or sales promotion.
Advertising versus creating a capital asset.
Exactly. Similarly, CIT v. ITC Hotels Ltd. ruled that expenditure related to the issue of debentures, even convertible ones, is generally revenue expenditure, facilitating the company's funding operations. And CIT v. Priya Village Roadshows Ltd. held that expenditure on a feasibility study for a new project, which is later abandoned without creating any new asset for an existing business, was revenue expenditure.
So expenses for funding or exploring expansion within an existing business framework tend towards revenue, unless a new capital asset is clearly created.
That's a good summary. Now, on the disallowance front, under Section 37, CITV CapScan and Diagnostic Center PLTD is significant. It disallowed commission paid by a diagnostic center to doctors for referrals, holding it to be illegal and against public policy, citing medical council regulations. This strongly reinforces Explanation 1 and 3 regarding expenditure prohibited by law.
Can't deduct payments for unethical or illegal practices?
No. And Millennia Developers PLTD v. DCIT confirmed that a fee paid to regularize violations of building bylaws is a penalty for infraction of law and therefore not deductible under Section 37.
Penalties aren't business expenses. Got it. Finally, the Maruti Suzuki case on payments to non-residents.
Yes, CIT Mimaruti Suzuki India Limited provided an important clarification for Section 40AI, disallowance for non-TDS on payments to non-residents. The Supreme Court held that if the payment made to the non-resident agent was not chargeable to tax in India in their hands, because the income didn't accrue or arise in India, then there was no obligation to deduct TDS under Section 195 in the first place. Consequently, no disallowance could be made under 40AI for non-deduction.
So the chargeability of the income in the recipient's hands is a prerequisite for the TDS obligation and potential disallowance. That's a crucial check. These cases really add color and practical meaning to the sections.
They absolutely do. They show how the principles are applied and debated in complex situations. Outro.
So what does this all mean for you? We've just journeyed through the vast and, frankly, quite intricate landscape of profits and gains of business or profession under India's direct tax laws. From the foundational definitions of what constitutes a business or profession, to the specific items of income chargeable, and then into the really detailed world of admissible and inadmissible deductions, deemed profits, and the crucial nuances of presumptive taxation, accounting standards like ICDS. Wow. It's clear this is a deep, layered subject designed meticulously, it seems, to capture all aspects of business profitability for tax, while also providing specific incentives and disincentives.
Indeed. Our exam-oriented summary approach, focusing on these details and illustrations, we hope helps you not just recall provisions, but truly comprehend their application. We've seen how specific examples, the nuances and definitions, the interaction between sections, and those judicial pronouncements don't just state the law, but bring it to life. They reveal the spirit behind the rules and how they apply in various, sometimes complex scenarios. We definitely encourage you to revisit any specific sections or illustrations that particularly resonated, or maybe sparked a new question in your mind.
This raises an important question for you to perhaps ponder on your own. As we've seen today, every detail in tax law, no matter how seemingly dry or technical, like the 180-day rule for depreciation, or the cash payment limits, or the disallowance of CSR under S.37, has a purpose. Sometimes it's preventing abuse, like disguised profit distributions through excessive salaries. Other times it's clearly about incentivizing certain behaviors, investment in R&D, skill development, digital transactions, specific industries. So for you, the learner, how does this deep dive into profits and gains change your perspective? Does it make you think differently about the decisions businesses make, not just the purely financial ones, but decisions about their operations, their structure, even their ethical considerations, knowing these tax implications are always in the background? Think about how these rules, seemingly abstract legal text, actually steer corporate behavior and investment, shaping the economy around us. What stands out to you after this comprehensive journey through sections 28 to 44 DB? Thank you for joining us on another deep dive. Until next time, keep digging deeper.